In the twilight of 2022, an empire built on the promise of revolution in finance crumbled with a velocity that stunned the world. FTX, once hailed as a titan of cryptocurrency trading, fell not just from grace but from existence, exposing a labyrinth of ambition unchecked by caution and confidence untempered by skepticism. Behind the dazzling facade of rapid growth and innovation lurked vulnerabilities no one dared confront until it was too late. FTX was more than a crypto exchange. It was a symbol of a new financial frontier, a platform that captured the imagination of investors worldwide by offering access to the volatile yet tantalizing world of digital assets. It mattered because it seemed to bridge the gap between traditional finance and an emerging digital ecosystem, promising transparency, speed, and democratization. Its founder, charismatic and bold, embodied a vision of limitless possibility. But within this vision lay the seeds of overconfidence, a belief that innovation could outpace regulation, risk management, and even basic financial prudence. The first warning signs were subtle, buried in whispers about opaque dealings and unusually intertwined relationships with affiliated firms. Early adopters and market watchers noted discrepancies in how customer funds were handled and murmured about aggressive expansion moves that seemed disproportionately leveraged. Yet these concerns were often drowned out by the roar of success, skyrocketing user numbers, headline-grabbing acquisitions, and an aura of invincibility cultivated by savvy marketing and an eager media. As 2022 unfolded, cracks widened. At its core was a dangerously blurred line between FTX and Alameda Research, its closely linked trading firm. This relationship was a crucible of risk blindness fueled by mutual dependency and a shared leadership that struggled, or perhaps refused, to impose checks on itself. The company's rapid expansion masked mounting debt obligations and liquidity gaps that became impossible to ignore when market conditions shifted abruptly. Crypto markets are notoriously fickle, and as asset prices declined sharply, so too did confidence. Two pivotal moments crystallized the impending disaster. First came revelations about questionable financial practices. Customer deposits were reportedly used to cover Alameda's risky trades without explicit consent. This breach of trust sent shockwaves through investors who began demanding withdrawals en masse. Second was the failed rescue attempt. When liquidity dried up, FTX sought external capital to stave off collapse but found doors closing instead. The ensuing panic was not merely financial but profoundly psychological. The erosion of belief in leadership's control marked a fatal fracture. Through these dramatic turns, human elements played as critical a role as market forces. Ambition blinded by hubris led to reckless decisions, fear-bred secrecy rather than transparency. Ego resisted accountability even as crises mounted. The very culture that propelled FTX's rise sowed the chaos of its fall, a cautionary tale where innovation without governance became its undoing. Looking back, FTX's story is both an indictment and a lesson. Unchecked ambition must be balanced with rigorous oversight. Trust is fragile and easily shattered by ethical lapses. Complexity demands clarity, not obfuscation. Could this have been prevented? Certainly, if risk had been respected over growth at all costs, if leadership had embraced humility rather than hubris, if transparency had trumped opacity. As we reflect on this seismic collapse shaking not only markets but investor confidence worldwide, we are left with pressing questions. What was the decisive moment when hope turned irrevocably into despair? Could another FTX rise from the ashes in today's still evolving crypto landscape? We invite you to ponder these questions with us. What do you believe sealed the fate of this once mighty giant?